Hello, today we're diving deep into a topic that most of us have been taught since childhood, but few truly understand: your savings account. For decades, we've been told it's the ultimate safe haven for our hard-earned cash, a symbol of financial responsibility. But what if I told you that this widely accepted wisdom is actually a comfort trap? What if your beloved savings account is, in fact, secretly making you poorer? In the next 20 minutes, we're going to expose a financial truth that banks hope you never discover. We'll uncover the invisible forces silently eroding your wealth, reveal the hidden costs that chip away at your money, and show you the massive opportunities you might be missing. By the end of this, you'll know exactly why your traditional savings account isn't helping you reach your financial dreams, and what powerful, actionable steps you can take to make your money truly work for you. This isn't just about numbers. It's about reclaiming your financial power. So lean in, clear your mind, and stick with us until the very end, because what you learn today could fundamentally transform your financial future.
The illusion of safety: why your safe money isn't really safe. For many, a savings account feels incredibly secure. It's insured by the FDIC, meaning the government guarantees you won't lose access to your money, typically up to $250,000. This undeniable benefit offers peace of mind, making it a viable option for your emergency fund, that crucial 3 to 6 months worth of expenses you need readily available. But for anything beyond that, this perceived safety can become a dangerous illusion. The problem isn't the safety itself. It's what this safety costs you. You see, while your money is safe in a savings account, it's often described as dead money. It's money that's been put out of active use in the economy, doing nothing useful for anyone, especially not for your future financial growth. The silent thief: how inflation eats your wealth alive. Let's talk about the biggest, most insidious culprit behind your shrinking savings: inflation. This isn't just a fancy economic term, it's a silent thief that's constantly at work, secretly stealing your money's purchasing power. Imagine this. You have $100 in your savings account today. If inflation is, say, 5% annually, and your savings account only yields a meager 0.42% or even 3%, your real return is actually negative. Even if your account balance nominally increases to $101 after a year, that dollar will only buy you what $98 could have bought before, because prices have risen. It's like running on a treadmill and expecting to reach Mombasa. You're expending effort, but you're not actually moving forward. The cost of goods and services, from housing to medical bills, keeps rising, and your savings account simply cannot keep up. This means that the money you worked so hard to save is effectively losing value year after year. Many of us remember our parents or grandparents advising us to put your money in the bank to grow it. And back then, with better interest rates and a less volatile economy, that advice might have held true. But fast forward to today, and that advice is often a one-way ticket to financial stagnation. The hidden costs and sneaky traps. Beyond inflation, traditional savings accounts come with their own set of hidden costs and sneaky traps that further erode your money. First, variable interest rates. Unlike a fixed deposit, your bank can decide to lower the interest rate you receive at any time, often in response to market conditions. This means the return you thought you were getting could vanish overnight. Second, fees. Oh, the fees. Banks can charge you simply for keeping your money with them. These can include monthly maintenance fees, fees for exceeding withdrawal limits. Even though federal regulations relax this, many banks still impose their own. Or even inactivity fees if your account goes unused for a period. These charges relentlessly eat into the money you've stashed away. It's like having a leaky bucket. No matter how much water you pour in, some will always slip through the cracks. Then there's the government. Yes, Uncle Sam wants a cut. The interest you earn from your savings account is generally taxable, meaning you'll need to send a portion of it to the IRS each April. It's another layer where your nominal gains are reduced to real losses. The biggest miss, the opportunity cost. This is where the real financial heartbreak lies. Opportunity cost. When you choose to keep a large amount of money in a low-yield savings account, you are actively choosing to miss out on potentially much higher returns from other investment avenues. It's not just about losing money to inflation. It's about losing the chance for your money to truly grow. Consider the story from a Reddit user who bravely admitted keeping over $100,000 in a savings account for 5 years, waiting for a property buying opportunity. In that same period, the S&P 500 index saw gains of over 200%, with additional dividends. What could have been $100,000 might have grown to nearly $210,000 if invested properly. The feeling of regret, the hindsight is 20/20 realization, is a powerful lesson. This individual confessed, "I messed up big time," realizing they had lost out on substantial growth by trying to play it safe. This illustrates a crucial point. Good is the enemy of great. While savings accounts are safe for the short term, they are not a great way to grow your money in the long term. For long-term goals like retirement or college funds, experts widely agree you need to include assets with greater risk and higher return potential. The bank's secret: why they love your dead money. So why do banks encourage this behavior? Because it's a lucrative game for them. The money you keep in your transaction and savings accounts, earning almost no interest, is a bank's greatest asset: cheap capital. Here's the secret they don't want you to know. Banks don't just hold your money in a vault. They take your deposits and use them to lend out to others, charging much higher interest rates on those loans. While they have a liability to pay you back, they effectively create new money through these loans. In essence, your savings become their funding, a virtually free pool of capital that generates billions in profit for them every year. They also strategically manage interest rates on savings products, often launching new, shiny accounts with attractive rates, while quietly lowering the rates on older, established accounts, without automatically moving existing customers. This product lifecycle management is designed to capitalize on customer inertia, costing savers millions in lost interest. Your money, meant for your future, is being leveraged for their immense profits. Breaking free: smart alternatives to make your money work for you. It's time to break free from the comfort trap and embrace smarter ways to make your money work for you. Remember, your savings account is a parking lot, not a highway to wealth. For your long-term goals, you need to get your money into the driver's seat. Here are some powerful alternatives to consider. High-yield savings accounts, HISAs. These are essentially souped-up versions of traditional savings accounts, offering significantly higher interest rates than the national average, sometimes even topping 5%. Many are offered by online-only banks, which have lower operational costs, allowing them to pass on better rates to you. They are still federally insured and offer convenient access to your funds, making them ideal for emergency funds and short-term goals. Just be aware that their rates can fluctuate. Certificates of deposit, CDs. If you can commit your money for a specified term, e.g. 3 months to 5 years, CDs offer guaranteed, fixed interest rates that are often higher than standard savings accounts. You'll know exactly how much your money will earn, and they are also federally insured. The catch? You'll likely pay a penalty for early withdrawals. Investment in yourself. Perhaps the most impactful investment is in your own education and skills. By acquiring new knowledge or enhancing your professional capabilities, you increase your earning potential, which has no upper limit. Reinvesting in your business or practice can also yield significant returns. Market-linked investments for longer-term goals. For goals beyond 3 to 5 years, where you have time to ride out market fluctuations, consider stocks, mutual funds, and index funds. These offer the potential for much higher returns than savings accounts. Index funds in particular offer a diversified, passive approach that can mitigate some risk. Bonds. Generally less volatile than stocks, bonds can provide stable, albeit typically lower, returns. Real estate. While often requiring significant capital and knowledge, real estate can be a powerful wealth builder. Diversifying within real estate, like through real estate investment trusts, REITs, can also reduce individual property risk. The key is diversification, spreading your money across different investment types to reduce overall risk and enhance potential returns. It's about aligning your investment choice with your specific financial goal, time horizon, and personal risk tolerance. Your financial future reclaimed. The days of passively accepting lackluster returns from your traditional savings account are over. It's time to take control of your financial future by embracing alternatives that not only protect your money from inflation, but also provide substantial growth opportunities. Remember, while a traditional savings account is excellent for your immediate emergency fund and very short-term liquidity needs, it is not designed to build wealth or secure your long-term prosperity. That responsibility rests with you, and the power to change your financial trajectory is in your hands. By understanding the silent threats of inflation and fees, recognizing the immense cost of missed opportunities, and actively exploring high-yield alternatives and strategic investments, you can transform your financial journey. Stop letting your money sit idle, becoming dead capital for banks. Instead, make it an active, powerful agent in building the prosperous future you deserve. The best time to start making your money truly work for you, right now.